Hello everyone, I am CA Prateek and in this video we are going to quickly revise the PGBP chapter, that is Profit and Gains from Business or Profession chapter in the CA Intermediate Income Tax. This is part 1 of the video. Okay, so let us start quickly. Firstly, I told you about the definition of business and definition of profession. Firstly, section 2 clause 13 defines business as business includes trade, commerce or manufacture or any adventure or concern in the nature of trade, commerce or manufacture. Then what is the definition of profession? Section 2 clause 36 defines profession to include vocation. Sir, what is vocation? Vocation is any occupation which requires a special knowledge. Fine. Then I told you certain facts about profits. Okay. What are profits? Profits can be in cash or it can be in kind. Okay, so if the profits are in kind, we have to tax the cash equivalent of the kind. Okay, then are capital receipts included in profit? Answer is if it is specifically given in PGBP chapter, then capital receipts are also taxable under PGBP. Okay, then voluntary receipts received in the course of business or profession should also be included in profit. I gave you an example that the lawyer is providing services to the client, but because of the lawyer's services, some third person is getting benefited. That third person is being very happy and giving some voluntary amount to the lawyer. Since this voluntary amount that is received by the lawyer, it is because of his profession, hence it will be taxable under business or profession. Okay, then application of gains is immaterial. If I received the profit and entire profit also I give it to charity, even still the entire profit is going to be taxable because they are going to see what is the income that is earned. The application of the income is immaterial. Okay, then income can be a legal income or illegal income. Both are taxable under PGBP. If the illegal income is the business of the person, then that even the illegal income will be taxable under PGBP. Then if PGBP is the aggregate of the all profits. Okay, so if you are seeing an assessee is having multiple businesses, you should not make the mistake of considering the main business as the PGBP income and all the other businesses should go to other sources. It is not like that. If there are multiple businesses, all the businesses combined will come under PGBP head of income only. So find the profit of each and every business separately, then add them together to find the total PGBP income. Okay. Next, P profit is the net profit and not the gross profit. However, to calculate the net profit, we have to follow the computation section. Okay, that is all the deductions and disallowances should be followed properly to find out the correct net income that is taxable under PGBP. Now let's come to charging section. Firstly, like any other head of income, even PGBP income has charging section and computation section. Section 28 is the charging section for PGBP. Okay, first point in charging section is any income from business or profession obviously will be taxable under PGBP head of income. Second, any compensation or any other payment due to or received by a person managing the affairs of the Indian company or Indian affairs of a foreign company is PGBP. For example, director receiving the sitting fees for sitting in the meetings. Okay. Next, the payment for agency services or termination of agency comes under PGBP. Next, if any government gives a contract, the sum received by the government for the government contract is taxable under PGBP. Next one, termination or modification of business terms. So if any business terms are cancelled or modified, then the amount received for such modification, it is taxable under PGBP. Next, if any income is received by the trade, professional or commercial association by giving service to its members, even that is taxable under PGBP. I gave you an example of Codicia. So if Codicia is giving service to its members, the amount received by Codicia will be taxable under PGBP. I told you that this is an exception to the principle of mutuality. If you don't know what is principle of mutuality, no problem, ignore it. Next, export incentives. Export incentives, there are 5 types of export incentives that are taxable under PGBP. Number 1, profit on sale of import entitlement. Number 2, profit on sale of duty entitlement passbook scheme. Number 3, profit on sale of duty free replenishment certificate. Number 4, cash assistance against exports. And number 5, duty drawbacks. So if you find such keywords in the question, you should be able to identify that this is going to be taxable under PGBP head of income. Okay. Next, let us see number 5, fifth point. Any benefit or perquisites that is related to business, it is taxable under PGBP. I gave you an example that a company is giving a free trip to Dubai to its distributor. Then this free trip is taxable in the hands of distributor as perquisites arising from business or profession. Okay. Then any sum due to or received by any partner of a partnership firm, it is taxable under PGBP. While discussing the salary head of income, I told you that any amount received by partner as salary will not be taxable under salary head, it will be taxable under PGBP head of income, because partner is the part owner of the partnership firm. Okay, and link chapter 3 also, we learned that share of profit received by a partner will be exempt in the hands of partner. Okay, next, any sum received for not carrying out any activity is also taxable under PGBP head of income. However, there are two exceptions for this point. Number one, if the amount received for not carrying out any activity, if it is taxable under capital gains head of income, then see the capital gains head, do not see PGBP. And number two, any compensation received from Multilateral Fund of Montreal Protocol, it is also not taxable under PGBP. If it comes in MCQ, you will be able to answer. Okay, fine. Next, any sum received for not sharing any know-how, patent, copyright, trademark, license, franchise, etc., it is also taxable under PGBP. Then any sum received under keyman insurance policy is taxable under PGBP. I told you that keyman insurance policy proceeds, if they are received by the employee, then it is taxable under salary. If it is received by the employer, it is taxable under PGBP. And if it is received by a third person, I gave you the example of Ratan Tata, then it is taxable under the income from other sources head of income. Okay, next, any sum received by transferring the capital asset on which the deduction has been claimed under 35 AD, it is taxable under PGBP. You should link with 35 AD section. Now let's come to accounting. Okay, so there are only two heads of income which require method of accounting, and they are PGBP head of income and income from other sources. All the three other heads of income take care of themselves. Okay, so section 145 subsection 1 tells that for PGBP head of income and IFOS, the assessee has the option to choose one of the two methods of accounting. What are the two methods? First one, cash system of accounting, and second one is mercantile system of accounting. Okay, cash system of accounting means what? Accounting in payment basis, and mercantile system of accounting means accrual basis. So any of the one method of accounting can be chosen by the assessee, and assessee has to make sure that he continuously chooses this method of accounting from year to year. However, in exceptional situation, he can change the method of accounting. Okay, next, there is an exception for method of accounting, and that is section 145B, which tells that if any interest is received on compensation or enhanced compensation, or any subsidy or incentive etc. is received by the government, then it is always taxed on receipt basis. Okay, you need not see the method of accounting for such income. Next, section 145 subsection 2 tells that every assessee has to follow ICDS, that is the income computation and disclosure standards. Okay, which is nothing but accounting standards but for income tax purposes. Okay, however, there are two exceptions for ICDS. So if an assessee is covered in any one of the 2 points, that assessee need not follow ICDS. First point is, any individual or HUF who is not required to get the books of accounts audited under section 44 AB. So if audit is not required, no need to follow ICDS for individual and HUF. Next, if any assessee is following the cash system of accounting, then no need to follow ICDS. Okay. Now let us come to section 44AA, compulsory maintenance of books of accounts. Okay. So firstly, let us see what is the time period till which the books of accounts have to be maintained. So time period to maintain books of accounts is 6 years from the end of relevant assessment year. 6 years from the end of relevant assessment year. So for how many years the books of accounts should be maintained? Previous year, assessment year, and 6 years before the previous year. Okay. Then, sir, where should we maintain the books of accounts? Answer is in the principal place of business. Okay, principal place of business. Now let us come to section 44AA 1 and 44AA subsection 2. So section 44AA subsection 1 tells that certain professionals have to compulsorily maintain their books of accounts. Okay, who are those professionals? Legal, medical, engineering, architecture, accountancy, technical consultancy, interior decoration, film artists, which include actor, singer, director, music director, lyricist, composer, etc., etc. Then company secretary and information technology profession. So all these professionals have to compulsorily maintain their books of accounts. Okay. Then we saw section 44AA subsection 2, which tells that the other persons apart from the above professionals, they have to compulsorily maintain the books of accounts if the conditions are satisfied. And what are the conditions? Condition for individual and HUF. If the business is an existing business or profession, then compulsorily books have to be maintained if the income exceeds 2,50,000 or turnover exceeds 25 lakhs in any of the three preceding previous years. Okay, and if it's a new business or profession, if the income is likely to exceed 2,50,000 during the previous year or turnover is likely to exceed 25 lakhs during the previous year, then compulsorily maintain books of accounts. Then other than individual of or HUF, if the income exceeds 1,20,000 or turnover exceeds 10 lakh rupees in any of the three preceding previous years, and in case of new business, if the income likely to exceed 1,20,000 or turnover likely to exceed 10 lakh rupees in the previous year, then other than individual HUF, they have to compulsorily maintain books of accounts. Then in case of 44ADA and 44AE, that is presumptive income sections, if the income shown is less than the presumptive income, they have to compulsorily maintain the books of accounts. And in case of 44AD, if the income is shown as less than the presumptive income, then for that year they have to compulsorily maintain. For the 5 years after the above previous year also, they have to compulsorily maintain the books of accounts. Okay, so this is special point about 44AD. Sir, you told who have to compulsorily maintain books of accounts. Now, what are the books of accounts that have to be maintained? Very simple. Such books of accounts have to be maintained that enable the assessing officer to determine the income. So, what books of accounts to be maintained? Such books of accounts that enable the assessing officer to determine the income. Very, very simple. Okay. Now, let's come to next point. Section 44AA subsection 1, that is the prescribed professionals have to maintain the prescribed books if the gross receipts exceed 1,50,000 in all three preceding previous years. Okay, and in case of new profession likely to exceed 1,50,000. So, sir, you already told that professionals have to compulsorily maintain books of accounts. Answer is yes. So the prescribed professionals have to compulsorily maintain books of accounts. What books of accounts? Such books of accounts that help the enable the assessing officer to determine their income. Okay. However, the prescribed professional have to maintain the prescribed books under Rule 6F. And what are the prescribed books? Cash book, journal, ledger, bills and vouchers. Bills if the sale exceed 25 rupees, okay, or purchase or expense exceeds 50 rupees. It has to be maintained by the professionals if their gross receipts exceed rupees 1,50,000 in all the three preceding years. Okay, not one of the three, in all the three preceding previous years. Okay, and in case of new profession likely to exceed 1,50,000. And one more special point, if a professional is a medical professional, then apart from the above books, that is cash book, journal, ledger, bills and voucher, the medical professional should also maintain a daily case register in form 3C, okay, and inventory of medicines as on the first and last day of the previous year. Okay, so I hope you are clear with maintenance of books of accounts. Now let's come to the most important part of PGBP, that is the computation section. Computation section is very simple. It just tells you to follow the section for to follow the section 30 to section 43D. Okay, now let me tell you something very important about computation of PGBP income. So when computation of PGBP is given directly, it is very easy to find the PGBP income. Okay, add all the incomes taxable under PGBP and reduce all the deductions allowed under PGBP to find the PGBP income. However, sometimes what happens is that net profit of P&L account is given in the question, and from that net profit you are asked to find out the PGBP income. So in such case, how to find the PGBP income? Let us see. So for example, this you are seeing on this screen, let it be an example of net profit. Okay, so transaction number A, if an income is there in the credit side of the P&L account and if the income is exempt from taxation, or let's say that income is taxable in some other head of income, then what are you going to do? You are going to subtract it from the net profit. Since while calculating the net profit, that income has been added and that income should not be taxable, so you have to reverse it. Hence, subtract that income from the net profit. Next, if there is a income in the net profit account which is a taxable income, then ignore the income because the income is already added in the net profit. Next, if there is an income which is, let's say, 20,000, okay, but the actual taxable income is 25,000, so the difference, that is 5,000 rupees, that you have to add to the net profit because taxable income is more. That is already 20,000 rupees is added to the net profit. Now 5,000 rupees extra you have to add to the net profit. Next, if the credit side of the P&L shows 30,000, but in that 30,000 only 10,000 rupees is taxable under PGBP, then what you have to do? The difference, that is 20,000, you should subtract from the net profit. Okay. Next, if there is an income that is not there in the P&L account itself, but such income is taxable under PGBP, then you have to add that income in the net profit because it was not added, so now you have to add it. Okay. Next, now let's come to the deductions. If there is a deduction in the P&L account, okay, and that deduction is disallowed expenditure, then what you have to do? You have to subtract it from the net profit. Okay, you have to add it back to the net profit because while finding the net profit it was already subtracted, so now you have to add it back to the net profit to reverse the transaction since the expense is disallowed expenditure. Also, the same thing you have to do if there is an expenditure in the P&L account and if it does not belong to PGBP head of income, then add it back to the net profit and then subtract it in that relevant head of income. Okay, you get my point. Next, if there is any transaction, that is, let's say, transaction X, okay, there is 25,000 in the P&L account, however only 10,000 rupees is allowed expenditure, then the 15,000 excess, that is difference, will be disallowed and hence it should be added back to the net profit. Okay. Next, if there is a transaction Y, okay, and 30,000 rupees is given in the P&L account and even in income tax this entire 30,000 rupees is allowed as deduction, then what you should do? You should ignore this transaction because while considering the net profit it has already been reduced as deduction. Next, if there is any transaction, let's say transaction Z, and the amount in P&L account is 40,000 rupees, however the expense allowed is 50,000 rupees, then what you have to do? You should allow extra 10,000 rupees, so you should subtract 10,000 from the net profit. Okay. Then if there is an allowed expenditure, let's say transaction T, which is already allowed, which is not there in the P&L account but it is allowed as expenditure, then what you have to do? You should subtract it from the net profit because while finding the net profit it was not subtracted earlier, so now you have to subtract it from the net profit. Okay. If you felt that all this I told it very fastly, then you can rewind and see this part again because this will be very important for you to solve the questions under PGBP head of income. Okay. So now let's jump to the computation section. Firstly, we are going to see the deduction under section 30, that is rent, rates and taxes, repairs and insurance to buildings. Okay, this amount of expenditure is allowed to tenant as well as owner. Okay, so whoever makes the expenditure, for them the expenditure is going to be allowed. Firstly, the building must be used for business at least for 1 day during the previous year. Okay, so business kaga use pannirukonu. Next, If the building is used partly for business, partly for other purpose, then proportionately allow the expenditure that is used for the business purpose. Next, if the a property is a sublet premise, that means the assessee has taken it on rent from the owner and given it on rent to some other person. So he is paying rent also, he is receiving rent also. In such case, the net rent is going to be allowed as expenditure, or net rent, if it is negative, it is going to be the income under PGBP. Okay. Next, if the assessee's own premises if the assessee is doing business in his own premises, then no notional rent is going to be allowed. This I told you in house property chapter also. In house property chapter, I told you if the assessee is using the house property for own business or profession, no need to tax it under house property head of income. Similarly, no expenditure will be allowed under PGBP head of income. Okay. So if the property is partner's property and the partnership firm is using that property, then the reasonable rent given to the partner will be allowed as deduction. The excess rent will be disallowed. Fine. Next, if the person does any capital expenditure on the building, then capital expenditure will not be allowed. If the assessee is the owner of the building, then capital expenditure will be added to the cost of the building and depreciation can be claimed on such cost. However, if tenant is doing capital expenditure on the building, this capital expenditure will become deemed building and tenant can claim depreciation on the deemed building. Okay. Next, let us see section 31, repairs and insurance to machinery, plant or furniture. Okay. First thing, this plant, machinery or furniture should be used for business purpose at least for one day during the previous year. Even passive use is allowed. Sir, what is passive use? Passive use means using as well as not using. For example, there is a fire extinguisher. Okay, only in case of a fire you are going to actually use it. But however, it is considered a passive use if that fire extinguisher is there on the wall. Similarly, if you have a standby plant and machinery, though you are not using it, still it is there for standby purposes, so it is a passive use. Similarly, if you are having tools or spares, you need not use those tools or spares every time, but since you are having them, it is considered passive usage. Okay. So even passive use is allowed. Now, if the asset is used for partly business or partly other purpose, then allow the proportionate expense. Next, if there is any repairs, then if the repair is for renewal or renovation, then it is a revenue expenditure. So allow it as deduction. If it is for replacement or reconstruction, then it is a capital expenditure. Do not allow it as expenditure. You add it to the cost of plant and machinery. Next, capital expenditure is not allowed. Okay, then rent, rates and taxes are not covered in this section. They are covered in residuary provision, that is section 37. Now let us come to depreciation, the very important section. Okay, so section 32 speaks about depreciation. Firstly, depreciation, for claiming depreciation, the assessee should be the owner of the asset. So only the owner can claim depreciation. If the assessee is not the owner, no depreciation. Hence, in the case of lease, both operating lease as well as finance lease, the lessor, since the lessor is the owner of the asset, the lessor only gets to claim the depreciation. Okay. If the assessee is a part owner of the asset, then depreciation is allowed on the assessee's share of asset. Okay. So next, the building owner need not be the owner of the land. Okay, so we are concerned only about the building owner, since depreciation is allowed for building and not for land. For land, depreciation is not allowed since land is considered to be appreciating. Next, depreciation is allowed even if the owner is not the user. I gave you an example already that if a lessor has given an asset on lease, okay, so who will be using that asset? The lessee will be using the asset, but depreciation will be claimed by lessor. Fine. Next, asset should be used for the purpose of business or profession, not necessarily the assessee's own business or profession, but for business or profession it should be used. Next, even passive use is allowed. If the asset is used for partly business, partly other purpose, then proportionate depreciation is allowed. However, only the depreciation that is allowed should be reduced from the cost of the asset to find the WDV. Fine, very simple. Next, the asset should be a depreciable asset. Sir, what are depreciable assets? Depreciable asset can be a tangible asset or an intangible asset. There are three classes of tangible asset. Class 1, building, class 2, plant and machinery, and class 3, that is furniture. However, intangible asset itself is a class of asset which includes know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial right of similar nature, for example, goodwill. So, intangible assets is itself a class which contains various types of intangible assets. Now let us see how to calculate the depreciation. So first we have to see what is the type of business. The type of business can be the business of generation or business of generation and distribution of power. Okay. So if it is one of the two businesses, then such two businesses have the option to choose between straight line method and WDV method to follow depreciation. Okay. All the other businesses have to compulsorily follow the WDV method for depreciation. Now let us see the difference between straight line method and WDV method. So straight line method, you have to follow separate asset system. That is, depreciation should be calculated for each and every asset separately. Okay. How to calculate the depreciation? Very simple. Depreciation rate into actual cost. Okay. Every time it will be depreciation rate into actual cost only in every year, because it is a straight line method. The depreciation rate you need not memorize, it will be directly given to you in the question itself. Okay. Next, if the asset in straight line method is sold off, okay, then there will be either terminal depreciation or balancing charge or capital gain will arise, which we will discuss in the capital gains revision lecture. Okay. Now, let's come to WDV method. In WDV method, block of asset system is followed. So, the assets which belong to the same class and same rate of depreciation, you have to merge all of them together, and aggregate of such assets will form one block. Okay, I gave you an example that in plant and machinery, computer has the rate of 40 percentage and books have the rate of 40 percentage. So computer and books both combined will form one block. However, building has the rate of 10 percentage, even furniture has the rate of 10 percentage. Can they merge to form one block? The answer is no, because building is a different class of asset and furniture is a different class of asset. So you should be careful as to what assets you should include to form one block. Okay. So how to calculate the depreciation? Depreciation should be calculated at rate of depreciation into actual cost in the first year and rate of depreciation into WDV in the remaining years. Okay. What is the rate of depreciation, sir? Rate of depreciation, it is given in your syllabus and you have to memorize all the depreciation rates. Okay, let us just quickly see the depreciation rates. So firstly, in case of class 1, that is building, the depreciation rate, if the building is used for residential purpose, it is 5 percentage, other than hotel and boarding house. For not for residential purpose and hotels and boarding houses, it is 10 percentage. Then if building is used for water supply project, water treatment system, 40 percentage, and temporary erection, 40 percentage depreciation. Next, for furniture, furniture includes electrical fittings also like wiring, switches, fan, light, etc. For furniture, 10 percentage depreciation. Next, for plant and machinery, general rate of depreciation is 15 percentage. So if it is not given below, 15 percentage depreciation. Okay. For motor car, if it is not given on hire, then normal rate of depreciation is 15 percentage. However, if the motor car is acquired and put to use between 23 August 2019 till 31st March 2020, then 30% rate of depreciation. Next, if the motor vehicles, that is motor car, truck, lorry, etc., etc., if they are given on hire, then normal rate is 30 percentage. If they are acquired and put to use between 23rd August 2019 till 31st March 2020, then the enhanced rate of depreciation is 45 percentage. Okay. So if there are two cars, okay, one car is coming in this category and one car is coming in second category, then both cars will form two different blocks since their rate of depreciation is different. Fine. Next, ships and boats, 20% depreciation. Molds in rubber, plastic, wood factories, 30% depreciation. Semiconductor industry, 30% depreciation. Then Computer includes computer accessories as well, like printer, scanner, etc. Software also included in computer. For computer, 40% depreciation. Life saving medical equipment, 40% depreciation. Pollution control equipment, 40% depreciation. Windmill generator on wind energy, 40%. Aeroplanes, aero engine, 40%. Water supply project, water treatment system, 40%. Okay, and for books also 40% depreciation. Now let's come to class 4, that is intangible asset. For that, 25% depreciation. Okay, so I hope you are clear with the depreciation rates. Okay, memorize the depreciation rates and be very thorough with them. Now let's come to the remaining points. One second. Okay, so how to calculate depreciation? Depreciation rate into actual cost, or WDV, as the case may be. Now let us see how to determine the actual cost of the asset. How to determine the actual cost? So firstly, in normal case, we have to see how to determine the actual cost. First, take amount paid for the capital asset. Okay, in that amount paid, you add the trial run expenditure, you reduce the trial run income. You add the taxes if no credit is available for the taxes. If credit is available, do not add the taxes. Okay, then if there is a loan taken for the purpose of the fixed asset, then add the interest on loan to the fixed asset cost till the fixed asset is put to use. So interest till the fixed asset is put to use will go to the fixed asset cost. After it is put to use, the interest amount will be claimed as deduction under PGBP. Okay, next, if any subsidy is received, then you have to reduce the subsidy amount from the cost of asset. And if any subsidy is received for multiple assets combined, for example, for 4 fixed asset, a single subsidy is received, then what you have to do? You have to proportionately decrease the cost of the assets. Fine. Then, if payment is made to a person in a day exceeding rupees 10,000 in any mode other than account pay check, account pay bank draft, or electronic clearing system, or any other prescribed mode, then such payment should be reduced from the cost of asset. What are the other prescribed modes? Credit card, debit card, net banking, NEFT, RTGS, IMPS, UPI, BhimPay, etc. Okay, so I hope you are clear with that provision. So all these steps if you do, finally you will get the cost of the asset. Okay, now let's come to special cases. Special cases, I explained you when we were looking in our study material from page number 4.194. Okay, let us see what are the special cases to find the cost of the asset. Number 1, if the asset was used earlier for scientific research, then the cost of the asset will be the actual cost minus deduction allowed for scientific research. Number 2, if any inventory is converted to capital asset, the cost of the capital asset will be the fair market value of the inventory on the date of conversion. I also told you that the difference between cost and fair market value will be income or loss under PGBP. So be very careful. Now, if any asset is acquired by way of gift or inheritance, then the cost of the asset will be the cost to the previous owner minus the depreciation allowable. However, if the assessee is making any expenditure for the purpose of that asset like installation, freight, etc., that also should be added in the cost. Next, in case of second hand asset, usually the amount paid will be taken as the cost of the asset. However, if the assessing officer is in suspicion that the main purpose of buying that second hand asset is to enhance the cost and claim extra depreciation to reduce the taxes, then assessing officer will come, take permission from the joint commissioner, and he will determine the cost based on the circumstances of the case. Okay, next, reacquisition of the asset. If the assessee sells the asset and reacquires that asset, then the cost of the asset should be the lower of the two. Number 1, actual cost when he first acquired minus the depreciation, and number 2, the price for which it is reacquired. So the lower of the two values should be taken as the cost of the asset when the asset is reacquired. Okay, next, acquisition of asset that is previously owned by a person to whom such asset is given on lease or hire or otherwise. Okay, so for example, I am the owner of the asset. if I sell this asset to another person and from that person I take that asset back on rent or hire or lease. So I am selling the asset and from that person I am taking that asset back on rent. In such case, in the hands of the other person to whom I am selling, the cost of the asset shall be my WDV. Okay, so my WDV will become his cost. Okay, next. A building previously is the property of the assessee. So an assessee, for example, I am having a building. Earlier I was not using the building for business purpose. Now suddenly after 2 years I am using that building for business purpose. In such case, the cost of the building in the business will be the actual cost minus depreciation for the years. Notional depreciation has to be provided. So if I bought the building 2 years back, I should put 2 years depreciation, and whatever is the WDV will become the cost of my building in the business. Okay, and remember, be very careful. This method should be followed only for buildings and not for other assets. So we also saw the question where it was given for a car. So if I buy a car before 2 years and now after 2 years I am bringing that car into the business, then the value of car in the business will be the cost of the car. Very simple. Only for building you have to reduce the notional depreciation. Okay, I hope you are clear with this. If you are not clear, go back, see this line again, you will be clear. Next. Interest paid I already told you. Then credit I already told you. If the credit is allowed, do not add it to the cost. If credit of tax is not allowed, add it to the cost. Subsidy also I told you. Next. If a non-resident, okay, if a non-resident has an asset outside India and he brings that asset into India for the purpose of business or profession, then the cost of the asset will be the cost of the asset in the hands of the non-resident minus notional depreciation allowed for that particular asset from the date of acquisition till the date it is brought into the business. Okay, this is also similar to the building provision which we saw. Next. If there is any capital asset on which deduction is claimed under section 35 AD, we know that the deduction claimed under section 35 AD is 100% of the cost. Hence, the cost for depreciation will be 0. Okay, this is applicable even if the assessee himself claimed the deduction under 35 AD or the previous owner is claiming the deduction under section 35 AD in case of gift distribution, liquidation, amalgamation, demerger, etc. Okay. So if deduction is allowed under section 35 AD, the cost of asset will be 0. Now let's come back. So we saw the normal cases, then we saw the special cases. Now let's continue with the depreciation provision. So while providing depreciation, okay, in depreciation in income tax, logic is not going to prevail. Okay, so if 10 months asset is used, do not provide 10 months depreciation. That concept is not there under income tax law. Then what is the concept? Concept is that if the asset is used for 180 days or more, provide full rate of depreciation. If the asset is purchased and in the year of purchase it is used for less than 180 days, then provide half rate of depreciation. Okay, and here be very careful that if the asset is purchased in 1 year and in the next year it is used for less than 180 days, in the first year it was not used at all and in the next year it is used for less than 180 days, then in year number 2 full depreciation is going to be allowed. Okay, so be very careful. I gave you examples also while taking the class. So if it is used for 180 days or more, full depreciation. If it is used for less than 180 days in the year in which it is purchased, then half depreciation. Okay. If the asset is sold in between the year, no depreciation for that particular asset. Fine. Next. Depreciation is a mandatory deduction. It is not optional. So whether depreciation is claimed or not, year after year, the WDV of the asset should be reduced. Next, no depreciation is allowed on land. And then any other business or commercial right of similar nature. I gave you the example of goodwill. Then there is definition of plant and it states that plant and machinery. So that plant includes ships, books, vehicles, scientific apparatus, surgical equipment, but does not include tea bushes, livestock, building, furniture, animals, human body and stock. Okay, so plant and machinery will not include stock, plant and machinery does not include building, plant and machinery does not include furniture. Okay, but plant and machinery includes ships, books, vehicles, scientific apparatus and surgical equipment. So you have to be very careful. So from this definition we get to know that buildings, furniture, plant and machinery and stock all are mutually exclusive from each other. One cannot be both. Okay, next definition of building. Building is a normal building that we all know. Apart from that, building also includes roads, bridges, culverts, wells and tube wells. Okay, and we already saw that if a tenant does a capital expenditure, then it will be a deemed building. Okay, so I hope you are thorough with this. Now let's come to the hire purchase provision. Okay, hire purchase. Okay, so we know that there is an installment system, there is hire purchase system. In case of installment system, ownership is transferred in the first installment itself. So in that case, the entire purchase will be treated as a purchase and depreciation will be allowed on the entire purchase price as per the agreement. However, if ownership is transferred in the last installment, it is considered as hire purchase system. So there will be two deductions. First deduction will be depreciation, second deduction will be hire purchase deduction. Sir, what will be the purchase price for depreciation? Purchase price will be the value of the asset as on the agreement date. Okay, and depreciation is allowed on the purchase price. Then what is the hire purchase deduction? Hire purchase deduction is equal to sum of all the installments minus value of agreement as on value of asset as on agreement date, which is nothing but the purchase price, divided by the number of years of agreement. Okay, so it will be the hire purchase deduction every year. I hope you are clear with this. We discussed examples also in the class. Then I told you, whenever you get a depreciation question, how to easily solve the depreciation question without making silly mistake. Okay, so first what you have to do, find the opening WDV plus purchase minus sales. Okay, you will get an amount. That amount you have to divide into three parts. First part, in the right hand side, you have to put the assets which are not put to use. Okay, in the total amount, first what you should do, put assets which are not put to use, and for that there will not be any depreciation. Second part, put the assets put to use for less than 180 days. Put the assets put to use for less than 180 days, provide half depreciation. Then the balancing amount will be the assets which are put to use for 180 days or more and provide full depreciation for that. So this final amount you need not calculate separately. Automatically what is the balancing figure can be taken and the depreciation rate can be provided. Okay. So this full depreciation plus half depreciation, if you add it together, you will find the total depreciation. Okay. So that was about depreciation. Now let us study the additional depreciation. Okay. Additional depreciation is allowed only if the assessee follows the WDV method. Okay, and then additional depreciation is not allowed if the section under section of 115 BAC has been chosen by the assessee. Okay, for additional depreciation, this 35% is not that relevant now. Okay, if you want, you can have a glance on the condition. I am going to discuss only the 20% additional depreciation. So 20% additional depreciation is allowed if certain conditions are satisfied. Condition number 1, the asset should be a plant and machinery. Condition number 2, it should be a new plant and machinery. Condition number 3, the assessee should be engaged in manufacture, production or generation or transmission or distribution of power. Okay, and manufacturing includes printing or printing and publishing. So that you have to be careful. So if all these conditions are satisfied, then for that new plant and machinery, 20% additional depreciation over and above the normal depreciation is allowed as deduction. However, it is allowed only one time. It is allowed only one time, and here also 180 days concept will apply. So if the asset is used for less than 180 days, then put 10% additional depreciation in the first year and remaining 10% in the next year. Okay. Now there are certain exceptions for additional depreciation. What are the exception? Exception number 1. ship or aircraft. So for ship or aircraft, no additional depreciation is allowed. Number 2, road transport vehicles. Number 3, any used plant or machinery. So for only for new plant and machinery it is allowed. Used plant and machinery, additional depreciation is not allowed. Next, number 4, any plant and machinery installed in office premises or residential accommodation or guest house, the additional depreciation is not going to be allowed. Next, number 5, office appliances. So for office appliances, example AC, cooler, etc., it is not going to be allowed. Then last but not the least, any plant and machinery for which the entire cost is already allowed as deduction, for such plant and machinery, no additional depreciation will be allowed. I gave you an example. If under section 35, that is for scientific research, if the entire amount is allowed as deduction, then do not come to additional depreciation to claim the deduction again. I told you that under income tax law, majority of the times for a single amount, benefit is given only one time. Okay, so multiple times same amount ku benefit kadikadu. If an amount is spent one time, benefit will be given one time and in only one place. So if deduction is claimed under section 35, no additional depreciation will be allowed under section 32. Okay, then there is investment allowance also. Now it is not that relevant because the time period is over. However, you can read it if it will come for theory purposes. Okay, then let me talk about succession. What are the four cases of succession? Case number 1, a firm or a sole proprietorship converts into a company. Number 2, private company or unlisted public company converting to LLP. Number 3, amalgamation. And number 4, demerger. So all these four are cases of succession. So in case of succession, how should you find the depreciation? Very simple. Calculate the depreciation as if there is no succession. Okay, after that, divide the depreciation between the predecessor and the successor in the ratio of the actual number of days used by the predecessor and successor. Okay, it is very simple. So okay, fully tired after telling you all these provisions. So part 1 comes to an end over here. In the next video we will discuss the part 2 and we will discuss all the other deductions, disallowances, etc. So keep learning, keep revising. See you in the next video. Till then, take care. Bye bye.